The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Thursday, the 31st of July. Welcome back, Jeremy. Good to have you here.
Hi, Gareth. Yeah, good to be here.
So we've got the usual vacillations from across the Atlantic. Trump doing his will he, won't he with the tariffs.
Yep.
There's been quite a lot going on in the US tech space as well. So why don't you give us your views on where the world is now and what you think might happen over the next couple of weeks?
Well, we began the week with the US and the EU striking a trade deal at the 19th hole of Donald's Turnberry golf course. But of course, these are not really trade deals, but more like what I would say are an exchange of social media posts waiting for confirmation and ratification. And I think in the case of the US, Trump's got form in getting congressional approval for his big legislative program recently. But it's worth just pointing out that things are not really so straightforward among the EU member states that have to presumably agree to whatever it is that Ms. von der Leyen agreed to. But this week was always going to be an interesting one with a busy macro calendar culminating in tomorrow's non-farm payrolls, but also accompanied by a blizzard of Q2 earnings reports from the US, which so far haven't disappointed. As you mentioned in your preamble, among the Mag 7, we had literally blowout earnings reports from Microsoft and Meta yesterday. And in the space of a few minutes, those two stocks added about $500 billion to the market cap of the S&P 500. And it's all about AI and it's all about AI spend. So I must hold my hand up so much for the idea of the end of American exceptionalism. Microsoft is up 50% since April. Meta is up 60% since April. These things have powered back. I just really wouldn't want to be short of NVIDIA right now.
Yeah, it's extraordinary how that market just continues to power on. And who knows when it'll slow down or, God forbid, stop. But as you say, it's pushing the US markets to ever higher highs, and bits of that are filtering out to the rest of the world. But at the moment, it's remaining quite concentrated in those names.
Absolutely. AI is just eating the world's equity markets. I mean, I think Microsoft is now a $4 trillion market cap company.
It just keeps going. So, yeah. And a lot of what we're seeing from other much smaller companies is the impact of AI, often in a negative way, or, people are worried about what it's going to do. And that's because the spend carries on. These AI servers are being rolled out, they're becoming more and more powerful. They're able to replace more and more entire jobs or proportions of people's roles and turbocharge employees to do much more in their day's work. So you need fewer of them. And it's the US tech giants who are making that happen. And so they're the ones sort of coalescing all of that value. So yeah, it's very interesting to see. But what's going on more broadly across the US market?
I think for political theatre, the highlight this week was always going to be Jay Powell's press conference following the FOMC decision that surprised nobody by keeping rates unchanged for another few months. And he didn't miss the opportunity to take a swipe at Trump and Bessent across the road at the White House following the meeting they had at the new Fed building last week. So following the decision, Jay Powell said, "We don't consider the fiscal needs of the federal government. No advanced economy's central bank does that. If we did do that, it wouldn't be good for our credibility, nor the credibility of US fiscal policy," which I loosely translated to mean, hold on, Donald, this ain't Turkey. But, more seriously, and I think critically, he also said there are risks both sides of the Fed's mandate, meaning that inflation could rise due to tariffs still, and that the labour market could weaken more substantially due to AI, among other things. Cue the non-farm payrolls tomorrow. And he was sort of pointing to a persistent stagflation-light scenario for the US economy. Now, we know the GDP figure is strong. The dollar is recovering. It was up 1% on the back of the Fed decision not to change rates, which tells you it's likely that rates are now going to be left on hold in September too. But over the last week now, the dollar's up by best part of 4%. So that combined with a very strong US GDP print, which defied all the tariff-related concerns, is really setting the US economy up for I think, a bit of an inflationary-led melt-up. And I think that if an incoming reformulated FOMC committee were to cut rates, as Besant and Trump are pressuring to do, then I think the genie would be out of the bottle on inflation in a way that I think Powell here is warning, in an EM style, maybe not hyperinflation, but certainly much heightened and permanently elevated level of inflation, such that any incoming perma-dove in the Fed would have to ditch the 2% target. That has all kinds of consequences that spill out way beyond the US economy.
And how quickly do you think that could happen? I mean, that's telling quite a scary story of where that could lead in terms of losing the independence of effectively the central bank, losing any real control over inflation. And presumably that would have a pretty big impact for the yield curve and for the currency, either in the short term or the long term, or maybe both. Are those sort of things that could happen quite fast, or do you think it'll be a slow, sort of steady decline as we understand and watch how Trump and Besant deal with Powell, or how Powell reacts?
I mean, in the aftermath of the press conference yesterday, the yield curve has actually flattened, the dollar has moved higher, but I think that's more to do with short-term expectations on the next move in rates. But to your point, the world is moved away from issuing longer duration bonds. We've talked about that before. The UK, Japan are witnessing 20-year plus duration bond yields at historic all-time highs. I mean, the highest in decades. The US Treasury is heading that way. So we're moving ever closer to direct monetization of government debt. It is not a coincidence that the Treasury is looking to issue T-bills to the newly regulated stablecoin industry. They're looking to deregulate the banking industry, balance sheet controls, so US bank balance sheets can buy more government debt. And the global appetite for long duration bonds seems to be dwindling.
Yeah.
It's difficult to see a positive future for sovereign debt markets.
And what do you think is going to go on with the UK? Because we've got our Bank of England interest rate decision next week. Do you think the Fed's failure to move will influence that at all?
Well, I think there's going to be some interesting discussions around the campfire at Jackson Hole next month, where all the central bankers gather together for their annual jolly. Historically, it's unusual for the Bank of England to decouple explicitly from the lead they tend to take from the Fed. And you're absolutely right. Expectations are for next week's decision by the Bank of England Monetary Policy Committee is to cut rates by 1/4 of a point. Far for me to sort of go against where market expectations are. But I think following the events of the last 24 hours, I would say that it's possibly less likely that the Bank of England will move this side of Jackson Hole.
Okay, we'll find out next week. So, yeah.
What have you been looking at in the UK this week? There's been quite a lot going on, hasn't there? A lot of results.
Yeah, it's been a very busy few days, actually. From the Progressive Client Stable, we had 4 particular bits of news. First of all, we had STV, the Scottish television group. They, on Monday, had a trading update. It was quite a downbeat commentary. They were talking about a deterioration both in the advertising and in the market for commissioning of programs that they're active in. So there's some quite big downgrades to estimates, and the shares fell quite dramatically on the back of that. It was interesting to compare and contrast STV's comments with ITV.
Yes,
had actually come out with a relatively benign statement. They had some pressures, but nothing quite like what STV were talking about on Monday. And a big part of the reason for that delta was really that STV has much less in the way of digital and much less in the way of international exposure than ITV does. But interestingly, both of those areas are key areas of focus for the new chief executive rolling out the recently announced strategy. So it's a shame that the strategy wasn't in place earlier, but at least it feels like they're dealing with the right issues and looking to move the business in the right direction. Then we had IG Design Group, the gift packaging, wrapping and stationery business. We had FY 2025 results from them. The key thing really at the moment with IG Design Group is the recent disposal of their US business, which was quite a big part of the overall group. They've moved to release the group from both the concerns or sentiment worries around tariffs and the underlying difficulties dealing with that, but also they've removed some quite significant working capital swings because that US business was really quite dramatic in the way that working capital moved across the year. So they've kind of de-risked the ongoing remaining business through quite an innovative disposal structure where they will still receive 75% of any net proceeds of that business from it, people that acquired it from IG Design, if they're able to sell it for a decent price down the track. So IG have quite cleverly retained some of the upside, but removed a lot of the risk. So that's some positivity there. Then we had Forterra, the brickmaker. They announced their H1 results, the period to June. It was a very robust performance, and it allowed us to put through some quite significant upgrades to our estimates. The share price responded nicely. And it's interesting to see that although across that building construction space, as we've said recently, a number of the house builders or the people involved in that supply chain aren't yet really seeing the full benefits of the Labour government's policy around trying to build as many new homes as they possibly can. That hasn't flowed through, at least in the brick market. Forterra are doing well. So it's nice to see them coming through and performing nicely. And then the last piece of news was SDI Group, which is involved in digital imaging and sensing and controls and those sorts of devices. They announced their year to April. That was very much in line with expectations. We left our FY26 estimates pretty much unchanged on an underlying basis. And it's nice to see them delivering on the new strategies. Essentially, they've got a good combination of decent organic performance from what's in the group at the moment and a resumption of the acquisition plan over time. So yeah, a very busy week. There was also some M&A activity that you noticed. What's been going on the acquisition side?
It's interesting, isn't it? We were talking last week about the significant number of warnings we've seen, most of which seem to be related to the US. But the market's grinding higher, so we seem to have transitioned to a situation where we've got a pretty horrible economy, but an okay stock market. And one of the factors driving the stock market is obviously capital flows. And in the last 48 hours, we've seen the best part of £3 billion worth of bids in the UK small mid-cap space through the acquisition of IPF by Base Point Capital for £400 million and Just Group being acquired by Brookfield at a staggering 75% premium to last night's closing share price, worth about £2.5 billion. So yeah, the underpinning for the UK market seems a lot healthier than the underpinning for the UK economy, I would say right now.
Yeah, it's certainly attractive in the eyes of those American bidders for those two assets. And more grist to the mill, people are saying that the UK market maybe still does have a number of undervalued or hidden gems.
For sure.
And the Americans are still coming over and still picking them up. So yeah, interesting activity to see. And what about next week? What have we got on the near-term horizon?
Well, we've got non-farm payrolls tomorrow, so we'll sort of see whether this sort of red-hot US economy includes the labour market, which has been showing signs of weakening up till now. We've, in the past, really only been concerned about the demand for labour in the US, but of course, policymakers now need to factor in the supply of labour because the dynamic has changed there with the changed migration situation in the US.
Yeah.
We've got some PMI data as well, and we've got the Bank of England rate decision on Thursday. I think the main focus looking ahead is going to be trade deals, non-trade deals, and whether Taco is going to be on the menu at the White House or whether at some point he stands tough and we get some form of trade war. He's sort of extended the runway for the discussions with China, which is obviously critical to the whole Trump playbook on tariffs. So this does rumble on, but it's going to stay front and center. And I think that's really what the market's going to be most focused on.
Absolutely. And we'll be able to discuss this time next week how that looks and what Trump has done with China, Canada, Mexico, Brazil. There's a whole host of different negotiating strategies I'm sure he'll deploy. And we can talk it through this time next week.
Okay.
Good stuff. Talk to you then.
Bye.
Brought to you by Progressive Equity.